Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights, the multifamily and marketing show. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Now, check this out. If you haven't already, make sure you leave us a rating and review, and also hit that subscribe button so you don't miss an episode. All right, today we're going to be talking to Larry Pendelton. Larry Pendelton has over 10 years of accounting, tax, and auditing experience as a certified public accountant. In addition, he brings over 7 years of real estate investing experience, and he is the Chief Financial Officer for CP Realty and Next Level Investments. In that role, he oversaw the accounting and finance of over $3 million worth of commercial real estate. Let's welcome to the show, Larry Pendelton.
Thanks for having me, John.
Absolutely. Larry, I know I went over your bio at a very high level. You have some other accomplishments as well. Why don't you take a minute and give us a little bit more context on your background?
Yes, besides PC Financials, co-founder of that with my partner, Terry Conyers, I'm also director of finance for Rize Equity, where we're just kind of finding the strong cash flowing assets so that we can maximize our investors' returns. And in my particular role, whether in PC Financials, Next Level Investments, or Rize Equity, is to implement the tax strategies needed from a real estate perspective in order to minimize our tax liability as well as our investors' tax liabilities as well.
Oh, that's awesome, man. So you really are working with investors, particularly in real estate, but also all over. I think I want to start with kind of, just that space, right? Understanding the tax code, and you mentioned, minimizing your tax liability at a very high level. Help us understand kind of your approach to taxes.
Man, my approach is that I look at the tax code as an incentive plan that the government is trying to have the people operate a certain way or move in a certain way to help benefit the country as a whole. And then if you follow these incentives or do these certain things, the government is willing to provide deductions, credits, basically different benefits to help minimize your tax liability or minimize the being taxed on the income that you're making.
Man, that's sound right there. You talked about it being an incentive plan. A lot of people will say words like loophole and things like that, but the way you characterize it, it's really an incentive plan to do the things that push the country forward. And those people who are taking advantage of that, they get the benefits of those incentives with reduced taxes. A lot of folks may not understand as we start getting into the financial space and get into technical terms. I know that you are a certified public accountant, a CPA. What exactly is the difference between a CPA and a regular accountant?
Well, your regular accountant is probably more just on the bookkeeping end of things. They can learn many of the aspects of being a CPA or tax or tax consulting per se. The main difference is that between accountants and CPAs, like there really isn't a huge difference. It's just, okay, CPAs are kind of taking that test, wanted to dig deeper, not just from a tax perspective, but from auditing, financial reporting from there, so that they can start public accounting firms from whatnot there. And then even with your CPAs, there is even a difference within the type of CPAs that you use. I like to consider CPAs and even your accountants similar to doctors, where it's like, okay, if you have a foot problem, you're not going to go to a dentist. Both are doctors, both are very educated and good at what they do, but one takes care of teeth, another one takes care of your feet. From that standpoint there, so I see accountants and CPAs in that same realm. Okay, you need to kind of know if you're going to be in real estate or if you're going to be a physician. Like, there are CPAs that specializes in those niches.
And on that point, Why is it important to work with someone who specializes in real estate versus, maybe a more general practice accountant or CPA?
'Cause most likely the general practice accountant or CPA, for lack of a better term, are just kind of jack of all trades and master of none. Like I said, uh, there's a lot in the tax code from that standpoint, and you can like it's hard to get into all the details of every single thing within there. That's why I like to use the doctor analogy, is because I mean there's all different parts of the body that needs to be taken care of, and for one person to do every single aspect of it, similar to the tax code, it's like, okay, you may know a lot in all the different areas, but to kind of get into the weeds a bit more and kind of and still provide a high quality service or value to your clients. That's why it's important to whatever business that you're in, investment opportunities that you're in, to work with not just CPAs, but for any professional that you're requiring that specializes in what you're doing.
Yeah, and Larry, like when we talk about real estate and the tax benefits, I know some people, some of my investors in particular, they may have their own CPAs and they're like, hey, my CPA doesn't know about some of this stuff. So talk about some of the tax benefits that actually are available through real estate investing that maybe accountants and CPAs, if you're not specialized in this space, you may not be aware of.
Yeah. So most likely all CPAs and accountants know that the income from investing in real estate, whether you're flipping or wholesaling or you're buying rental properties, is tax advantage, which means that you're not taxed on the gross, you're taxed on the net. So everyone's always kind of like trying to write off a whole bunch of additional expenses, just trying to get that net number down. But does that really does that really make it a great cash flowing asset per se? So now there's also other deductions such as depreciation from that standpoint there, where you're just taking the value of the building and you're breaking it up over whatever asset that you're acquiring. You're breaking up over the certain number of years that the IRS says, okay, you can recover the cost of the building over these certain years because you had this income producing asset per se. You just can't write the whole thing off. Where the benefits kind of may get lost after that is that there could be cost segregation as well, as which allows for a lot of that depreciable cost to be accelerated or depreciated faster in earlier years. And you're basically applying the time value of money at that point, where like you much rather uh, take take the deductions now instead of breaking it out over however number of years, depending on the asset and the value as well.
Yeah, that cost segregation. I mean, that basically is an engineering study that allows you to break down the components of the property and accelerate that deduction. And that can be huge. I mean, absolutely huge for investors where maybe, in the past you would only be able to take a smaller portion of a deduction or depreciation. Now you can fast forward and correct me, but I think it's the first 5 years and you can break down the first 15 years as well for some of those components. So that allows you to take a much bigger deduction for that property. Now, there may be some confusion, and I think some investors may not know exactly, but who exactly does this benefit? Because I know for every investor, you may not be able to take all of those benefits at one time. So who exactly does the cost segregation, the bonus depreciation? Who does that benefit the most?
Well, anything depreciation related is going to in the real estate world, since that's the podcast that we're on, is mainly going to really, benefit those that invest into rental properties, whether a single unit or a 1,000 unit portfolio. Because those are seen as income producing assets. It's not going to benefit wholesalers. It's not going to benefit brokers. It's not going to benefit flippers, because the activity at that point is considered more of an inventory per se, and that's going to be sell, and there's a short term benefit. So anything that's considered kind of a long term income producing asset, it really benefits those that takes advantage from that standpoint there. So that's kind of just one caveat there. Then, like I said, we can go into if the losses that creates, it can benefit from that standpoint. But to answer your question, rental property, a real estate investor, that's what depreciation, cost segregation, that's who it benefits the most.
There you go. So if you're flipping, wholesaling, you're a broker, doing a cost segregation, or you're trying to get bonus depreciation, it's not going to help really that asset. But if you are an investor in longer term hold properties, rental properties, that's where you're starting to look at this. What's the break point, right? Is it a single family house that I should be looking to do a cost seg, or is this really only for large commercial apartment deals?
It depends on how much the value of the asset is, because there are companies and softwares that you can do cost segregation on a single family home or even a townhouse if you're renting it out from a standpoint. Because when people typically hear cost segregation, they think about apartment buildings, they think about 4 or 5 figure of cost to kind of get this report done, and that may not make sense for anything for a quad or a duplex. And like the opportunities are there, and there are more affordable options for those smaller properties. So there's not really a threshold. It's just, okay, depending on the size of the property, and then applying the correct cost seg that needs to be done to take advantage of it.
There you go. So you can do this on a lot of different rentals. You probably just need to figure out what the cost is going to be, what the benefit's going to be to you, and then what
Right.
your ultimate business plan is. So lots to look into. I want to switch over and talk about the loss side a little bit there. Obviously there's a lot of benefit here. Most of the benefit is being able to take these losses. Talk to us a little bit more about what those benefits look like and who does that impact the most as far as the investors?
Right. So to kind of take it back, where the income being tax advantage and your tax on the net and on the gross, I guess all the time when we're running our numbers, we're expecting to be in the black. We're expecting to be positive, the net operating income to be positive. But the depreciation, whether you're taking regular or bonus depreciation or accelerated depreciation, could possibly take that NOI to a loss per se, but that's for tax purposes, because the depreciation is a paper loss. It's a non-cash deduction that's coming out of pocket. So you're able to take this net operating income, possibly have a loss, and then from there, that's when it kind of gets fun in determining whether or not you can actually claim these losses, or these losses can lower your tax liability. Now, where it gets fun is because rental income or rental activity is considered passive per se, and then passive activity cannot offset active activity or non-passive activity. So whether you still have your W-2, or even if you are a flipper or a wholesaler that has some rentals on the side, okay, depending on your adjusted gross income, and then the amount of losses that you're trying to recognize, you may not be able to offset those losses against your active income, unless there's many stipulations. One being a real estate professional, or the real estate professional status qualifying for that, and that would basically, in a way, open up the floodgates in a way to let you take these passive losses and actually offset your active income if you're over certain thresholds at that point.
Yeah, so basically to recap, you're saying that, hey, for your passive losses here on from the bonus depreciation, you can take that against that asset. So if you were to make, let's just say you invested $100,000 into an apartment deal, say you made $8,000, whatever bonus depreciation you took, you could take that against both that or that passive income, and keep me right, across other passive income as well, right? Or across other rental income. Okay.
So anything that you're considered passive at, where let's just say you're 8,000, your net operating income, your depreciation is 10. So that brings you down to a $2,000 loss, depending on how your entity, your structure is, or if it's just all in your personal name or in your personal LLC. That $2,000 loss that's kind of sits on your books, or on your tax return. And I say is looking for other passive income to eat up against. Now, if you don't have anything to kind of eat that up against, then depending on, like, say, if you're making over 150,000 in act or your adjusted gross income, okay, you're not going to be able to apply that 2,000 to anything else to help reduce your tax liability even more. But it doesn't disappear. It doesn't go away. It just kind of goes into basically on the side, and it just kind of deferred into future years. Then, like, it could potentially in future years offset against other passive income, unless, like I say, you can get to qualify for certain things, whether it's the real estate professional status, or if you got your adjusted gross income down below 150 and be able to take a certain phase out from that standpoint there.
Yeah, so there you go. So now you have some options there. That loss would carry forward. It can be used against future losses. And then if you had, let's say you had other passive income in, and I'm curious what qualifies in regards to passive versus, earned, like the stock investing, for instance.
Mm-hmm.
If you had a stock portfolio that was making money, would you be able to use this against that or not?
Stock investing be considered non-passive from that standpoint. So, like I say, it kind of goes back into, okay, can you trigger the passive losses to become non-passive so they can offset other non-passive income? So, like I said, the opportunity is there. It's just everything, like what qualifies for that standpoint.
Yeah, it gets a little complicated at that point. But I mean, the point here is this: if you have other passive income, or if you are in a position where you have, you're a full-time real estate professional, I mean, this could be a blockbuster for you because now you're not only limited to the passive income losses, you can take this against your earned income. So lots to read up on. I mean, this is not the time we're going to go super deep into this, but the bottom line is this: there are a lot of tax advantages. One of them is taking advantage of the bonus depreciation component. You see this in a lot of real estate syndications in particular, but it's not limited to just real estate syndication. So read up on that if you want to learn more. I want to transition and talk about something else now, though. As we talked about, just where we are in the world right now, still kind of, dealing with COVID, and the government has issued, different acts, the CARES Act and things like that. We're getting into tax season now. I'm curious to understand, like, what are some of the support, some of the things that are out there that are available to help investors and business owners in regards to, the PPP and CARES Act and some of the new legislation that's come out as well.
Yeah, there's a lot of, like, the PPP information is still kind of rapidly coming in. I think the main thing, even with the first round of PPP funds, there are opportunities to kind of get that forgiven, the loan forgiven. So, like I said, depending on if you're showing a certain amount of loss in activity during 2020 as well. So, like, that's definitely something to kind of work with your bookkeeper, your accountant on, just to kind of make sure the books kind of show that, and working closely with your banker in order to ensure that you're making all the qualifications there. There's opportunity to get your tax return kind of done quicker. I know we're just kind of in the second week of the year, but especially for those who don't have W-2s or at least got their business information set up where they can still file and quite possibly amend their return, but they just want to show their business information on their tax return. Like I said, depending on, like I said, they haven't opened up the filing date as of yet, so it's still all kind of in play. But being able to kind of get the assistance with the PPP additional money, as well as get that forgiven, that's a huge jump there. Part of the Tax Cut and Jobs Act was the bonus depreciation of going from 50% up to 100% for any asset that depreciates less than 20 years. So not necessarily a building per se, but furniture, equipment, land improvements, so forth. From there, kind of take the opportunity to once again get those caught up, get that depreciation recognized earlier in year one, and then especially if you're holding it long term, and kind of go from there. And then there was also the qualified business deduction as well, where basically you can up to 20% of your gross income or your net income can be is subject to not being taxed at all. To kind of explain it the most simplest way I can put it. So there's of course a bunch of criteria and whatnot to ensure that's the case, but there's opportunities that COVID has basically put the government in a awkward situation, and especially with the Trump presidency and the Tax Cut and Jobs Act that came out before COVID. So that in combination of the CARES Act opened up a few doors of relief for a lot of investors and just business owners in general.
Yeah, and we're obviously going to see. I mean, this is a continually evolving situation in regards to the relief acts and things like that. You mentioned the program that Trump put out. As we're recording this, we're in early to mid January. We are a little bit out from President-elect Biden being sworn in. For you, and as you talk to your clients, what are some of the policy changes that you're anticipating or things that we may want to preemptively prepare for as we look at a Biden presidency?
A lot of things that have been talked about and the certain things that are on the chopping block is the step up basis. It is one where for a lot of people who are passing down real estate to their heirs, or that kind of done the 1031, just constantly exchanging up and up. So so that value at the time where the asset that's passed down to the children, is now the value as it is at the date of it being transferred down. Like that's the new value. That's the step up basis there. So that if they do decide to sell that property afterwards, they're not selling at the original cost, the building, however long it was bought ago. So that's potentially on the chopping block. Whether they pass it or not is always tough to say. With those things, it typically takes a year or two for any president that comes in to kind of push their whatever agenda that they have. I typically see just a lot of just presidents just kind of yelling out stuff, just kind of get voters interested, especially those that are against the wealthy or whatnot there. So that's one thing, to step up basis. The 1031 exchange is something else that's potentially been discussed as being on the chopping block as well. And that's, of course, when you're taking the gains from whatever property you're selling, and as long as you're kind of following the proper protocol, you can roll those gains into another property and not be taxed on those gains from that standpoint. So that's also potentially on the chopping block as well. And then, like I said, there's I'm trying to think which one to pick. There's a lot to choose from that's potentially up there, but
you get two big ones right there, though. You get two big ones. I mean, the step up basis, that's a huge one, because essentially that's one way to transfer wealth generations without having to pay those taxes, and those capital gains taxes could be huge. So I mean, that's one great thing, and obviously the 1031 exchange, that's something that's been talked about often. And I was speaking to a 1031 exchange specialist, and she told me, every time there's a new president, this comes up, and they start talking about, getting rid of the 1031 exchange, going back to the Clinton administration. So we'll see if this gets traction or not, but obviously things for us to pay attention to. Larry, one thing that has been real clear to me is there's a lot of stuff in this space. This could be pretty confusing if you're not living in it and breathing it. So for folks who don't necessarily have the bandwidth or the time or the energy to try to figure out every single tax or financial strategy and everything else going on, I guess the main question is, we got to get somebody like you on our team, right? We've got to find us a great, CPA, tax strategist, someone on our team that can help us navigate this landscape. How should we go about that? What should we be looking for in a tax professional to join our team?
I think just one-on-one calls, whoever you're reaching out to. Because some have websites, some don't, and the website's only going to tell you but so much. But just kind of get a general idea of how that individual sees the tax code. I think that's a kind of common question I get all the time is, how do I feel about the tax code? And some some CPAs and some other tax professionals just see it as just rules of how to get taxed, and there's others like more or there's many that are on the side of that I'm on of just seeing it as of that incentive plan there. And then just kind of like, are they also investors? Because at the end of the day, if like I say, if they're not investing, now I'm not saying they can't provide the same type of quality service, but at the same time, anything that I do or any other tax professional who's investing do, like they're recommending stuff that they have done themselves or they plan on doing once they get to that point, or they're constantly they've seen before, because that's all that we're really looking at is the strategy around how to best maximize our tax benefits through real estate from that standpoint there. So like that's those are two key things there when you're interviewing just different tax professionals of just, okay, how are they viewing the tax code? Are they scared of it, or are they see it as opportunity to kind of press the matter legally in order to, once again, just maximize tax benefits from that standpoint there. So, and then like, are they also investors as well? Like, do they understand the business side of it? Do they understand the investment side of it? Because at the end of the day, the tax tail should not be wagging the investment dog itself. So it's a good support. It should not be forgotten about. It's always part, but like those opportunities to kind of see, okay, I have this tax strategy. It doesn't fit this investment, or you may not qualify for it, and kind of go from there. And also just honesty. I mean, a lot of people are just kind of looking for someone just to tell them, yes, they can qualify this and whatnot. And sometimes you have to tell people, like, no, like this doesn't work for you. And if there's a disagreement, there's okay, well, we may have to just move on, because I can't tell you what you need to hear. I need to tell you what you need to know, because I can't aggressively put certain strategies for you if I can't cover you on the back end for the if you're ever small percent chance of being audited. I want to be able to make sure that whatever strategy that we end up going with, or whoever tax professional that you end up going with tells you, they need to be able to protect you. It's like, here's why this is why you're safe, because it doesn't say you won't be audited. It just say if you are, you have these things that you've done that we implemented to help protect you.
Yeah. So what I heard you say was that you talked about how they view the tax code, right? So do they see it as, an incentive plan, or do they see it as, laws and rules and regulations that they're scared of and they don't want to challenge or get close to? And I think it comes down to, are you working with someone who's going to be very conservative, who doesn't want to do any work, meaning that they are happy to do your taxes for you, but their goal is to avoid an audit at all costs, or someone who's willing to push and get the advantages so you can save as much money as possible, get all the tax benefits that you qualify for, but also recognize that, hey, this may get challenged. So you need to have all your books in order, your receipts, your documentation, and demonstrating why the strategy worked for you. So, is there a question, or is there a way to kind of get at that question when you're interviewing and talking to someone, so you can get a sense of, hey, this person is going to be my partner that's going to help me, take advantage of the tax code and save as much money? Or is this person going to be just super really conservative? And yes, it's going to be accurate, but I'm leaving dollars on the table.
The best question to ask there is, how do you bring value to my business? That's the best question there. Like, how do you bring value to my business? Other than just, cause like, yes, you can write off my fee, whatever. Like, yes, you have that, but, does taking a conservative route really add any value, or you just, at that point, you're just another expense, another annual expense for the person? You're not really adding any additional value from that standpoint there, where, so that should at least trigger that conversation a bit more, or kind of put whoever you're interviewing in a sense of, okay, how am I bringing this person value, other than just, I'll get your tax return done and and it'll be done right, and you don't have to worry about being audited. But it's like, okay, is that really a value? Because anybody can do that. Anybody can just take your numbers, throw it into a system. We all use the software. Like, no one's doing this by hand. So we just happen to know like a bit intricacies of the tax code of, okay, here's how it needs to be entered, so forth from there. But if that's the case, then like, how am I really bringing value to your business and to your investment? So if I'm not putting certain strategies in place, if I'm not highlighting certain things that you need to be looking out for, like, cause it should be a partnership per se. I should be seen more as an asset instead of just another expense. Because if we're seeing opportunity where a cost set can be very valuable, okay, we need to shoot for that. See if we can get 25% of this building cost to be able to be bonus depreciated up front more. Like, why not look into that, see what that value is? Or if you have to sell a property, okay, do you need to do a 1031 exchange? It may not be the best choice all the time. You may not even have to do it, depending on if you have passive losses enough built up to offset the gain, from that standpoint there. So the question of how does someone bring value to you and your business should be at least top three questions at least, because that will help get to that point of, okay, how is this person communicating that value to you, and does that make sense? Does it sound all up and up, or they're just saying all the right things to make you feel better about throwing a fee their way?
Great answer, Larry. Let's move on to our bullseye round. You ready?
We'll see.
All right, Larry, give me a failure or an apparent failure that set you up for later success.
Probably my first flip, and that was 4 years ago, and just the aspect of just trying to do it all myself, not recognizing my weaknesses, and not getting the right people around me. I tend to be more of a team person, but like I said, I did a terrible job of just kind of assessing the people around me, assessing the work that was needed to be done. And since then, partnering with the right folks, that their strengths leverages off of my weaknesses, as well as like my strengths leverage up against theirs, where it's like, hey, that's how I add value to them. It's like, whether we're just partners from that standpoint there. So that has led to, okay, being able to acquire more properties, assessing whether or not the stress of a flip or any property, like how is that time value as well, like that return on my time, as well as return on the investment itself. So that particular failure just had me look at life differently, not just real estate investing.
Give me a digital or mobile resource you recommend for your business.
Calendly is a really good one, where I can just kind of put it out there, and I can set up a certain way where people can only block out times on certain days, so I can actually spend a good chunk of the day like doing what people are hiring me to do, not just in meetings all day. So it definitely helps take that part out and helps me plan out my weeks and plan out my days as well.
Give me the book you've recommended or gifted the most in the last year.
The last year? Wow. Do I have to do one?
Yeah, you can do another one if you want. I need at least one though.
The most recent one is Who Not How, and I can't remember the author. I have shot that out to so many people, and just the general concept of that is, if your goals do not require you to bring on other people, your goals are too small. And that just kind of just blew my mind when I read that. And I said, it was only probably about a month ago I got that book, and that one stuck with me. That's gonna stick with me for a while, because it kind of to that point I was making earlier about my failure, is like that's it. Like all these things that like I'm not good at. Like instead of banging my head against the wall of how I'm gonna do this, how about who do I need to bring on that's good at that, so that okay, now let's look at a bigger deal, so that everyone feels as if their time and their investment is worth getting into this opportunity.
All right, give me a daily habit that helps you stay focused on your goals.
5 to 10 minutes, if not longer, just morning meditation. Like I said, try to work out as well, but just like I said, and I'm not perfect at it at all. But like I said, at least 5 times a week, just waking up early. Kind of got that from the Miracle Morning book, and it's applying that just focus for the day, gratitude, abundance, make sure that's in my mind as I attack each day.
What's one thing you know now that you wish you knew when you were starting out?
That I didn't have to do it all myself. Whether it's my tax business, whether it's real estate, and yeah, that it doesn't have to be all done. This isn't school or our schooling system where it's kind of predicated on you kind of knowing and doing everything yourself. Where like life in general is a team sport, no matter what you're doing, and to try to do everything yourself, like you're going to burn yourself out. And I wish I would have known that sooner. Things would be just a lot differently. I'm grateful for what I've gone through, and it taught me so much and who I am today. But I guess we all like the easier road. Wish I could have found that road a bit sooner.
What are you curious about right now?
Man. To be completely honest, just where the country's going from a societal standpoint. I mean, I know we're on a real estate podcast, but I like to think deeply amongst other things like that, and what my part need to be in order for us as a whole to kind of get through all of the craziness of a pandemic and the social injustice and everything, where there seems to be a even bigger divide happening, and like where can I help serve to help build that up to a better place.
I appreciate that. And Larry, where are you located right now?
I'm in Norfolk, Virginia. So
all right, Norfolk.
Roads,
all right,
Northeast Virginia. You
all right.
tell by the accent.
You know what? Now that you say it, I can hear it a little bit. But look, let's give me the best place to grab a bite out in Norfolk.
I'm a big guy, so there's a lot to choose from. Croaker spot. People like some fried seafood. So Croaker spot off of 35th Street is a good spot to go.
All right, Larry, you gave us a lot of great information, man. I really appreciate you talking about, just really helping us understand from a contextual standpoint about, accountants and CPAs and just kind of the differences there, and really understanding how, the tax code is set up as an incentive plan. I think that's some great perspective for people who are looking to take advantage and really get more benefits out of their investments, as well as talk a little about, the PPP and the CARES Act and, some of the things that are going on there. And then lastly, helping us understand more holistically about where things are headed from, what we can expect with the new administration. For folks who want to learn more about you and your business, and maybe as they go through their vetting process to figure out what tax professional they need to bring on their team, what is the best way for them to reach out?
They can text or call me at 757-535-8592. That's my cell phone. Like I said, just all day, every day, just like I try to respond within 48 hours to anyone that reaches out to me. That you can also reach out I'm on Instagram, Facebook, LinkedIn at Larry Pendelton. Larry Pendleton, the CPA. You can reach me out there, and then my email. I'm assuming there'll be show notes and whatnot. So there's the tax business at info@pcfsva.com, as well as multiple investment groups that I'm in. So I think it just is kind of, before we kind of go to all my emails, those are kind of the best ones. And then, like I said, I can send a link to my calendar, and people want to throw 30 minutes on my calendar, that's fine as well. And looking forward to meeting anyone that wants to learn more and add value where I can.
Larry, listen, man, I appreciate you coming on the show and sharing your contact info. We'll make sure we link to that in the show notes. Thank you for being a guest on Target Market Insights, the Multifamily Marketing Show. We'll hope to see you and talk to you again soon. Take care, man.
Appreciate it.